Tariffs, market volatility, global headlines that shake investor confidence in seconds. One tweet from a world leader can cause the Dow Jones to tumble. One unexpected tariff on imported steel, and entire sectors lose billions. But why? Why are investors so reactive to these seemingly distant policy decisions? The truth is, every tariff imposed and every swing in market sentiment can directly impact your portfolio, your retirement fund, and your financial future. Whether you're investing in individual stocks, mutual funds, ETFs, or just starting to understand the market, grasping how global events like tariffs and market volatility influence investment behavior is crucial. In this video, we'll explore what tariffs really are, how trade wars create shockwaves, what volatility actually signals, and what smart investors do to protect and grow their money during such uncertain times. So if you want to move from panic to power, stay with us. Part 1. Understanding tariffs. A tariff is a form of tax imposed by a government on goods and services imported from other countries. The main goal? To make imported goods more expensive, thereby giving an edge to domestic producers. On paper, this sounds like a strategy to protect local jobs and businesses, but the real-world impact is far more complex. Imagine a US-based car company that imports parts from China. If those parts face a 25% tariff, the cost of producing each vehicle shoots up. To maintain profit margins, the company raises car prices, which reduces demand. Lower demand leads to reduced sales, and in turn, job cuts, decreased revenue, and falling stock prices. Investors holding shares in that company now see a dip in their portfolio. And that's just one example. Tariffs disrupt supply chains, delay manufacturing, increase inflation, and strain international relationships, all of which introduce uncertainty. And uncertainty is poison for financial markets. Part 2. The escalation. Trade wars in action. A single tariff can be manageable. But what happens when countries retaliate? That's when a trade war begins. Let's revisit the 2018 to 2019 US-China trade war. It started with tariffs on Chinese solar panels and washing machines. China responded with its own tariffs on American agricultural products. Over time, both countries placed tariffs on hundreds of billions of dollars worth of goods. The result? American farmers lost access to the Chinese market. Chinese tech firms faced restrictions on critical US components. Companies like Apple, Boeing, and General Motors found themselves squeezed by rising costs and shrinking global demand. Markets didn't just react, they swung violently. The S&P 500 had one of its worst Decembers in decades in 2018. Investor sentiment flipped from optimism to fear almost overnight. What began as a policy move turned into a psychological war, where uncertainty made investors doubt earnings, growth, and even economic stability. Part 3. What market volatility really means. Volatility is often misunderstood. It's not just about prices going down, it's about how quickly and how dramatically prices fluctuate. If a stock moves 2% in a week, that's normal. But if it jumps 5% one day and crashes 7% the next, that's high volatility. Now add tariffs and political tension into the mix. The result is extreme market swings. This happened during the Brexit vote in 2016. When the UK unexpectedly voted to leave the European Union, markets around the world dropped instantly. The pound hit historic lows. European stocks plummeted. US markets followed. Why? Because investors hate the unknown. Tariffs introduce variables into the market equation that analysts can't easily predict. Volatility surges as algorithms trigger sell-offs, stop-loss orders get hit, and margin calls accelerate the crash. But for experienced investors, volatility is also an opportunity. It's the moment when undervalued assets become available at a discount. It's when the emotional sell-off creates entry points for patient capital. Part 4. Case studies in tariff-induced panic. Let's look at some notable cases. In August 2019, a simple tweet from then-President Trump announcing additional tariffs on Chinese imports caused the Dow to drop over 600 points within hours. Investors scrambled, tech stocks dipped sharply, and safe haven assets like gold surged. In May 2019, when trade talks collapsed unexpectedly, global markets lost over $1.5 trillion in combined value in less than 2 weeks. Another example, India's 2019 tariff increase on over 28 U.S. goods, including almonds and apples, as retaliation for the U.S. removing India from its generalized system of preferences. U.S. agricultural exporters lost contracts and related stocks took a hit. Then there's the oil market. In 2022, when Europe imposed tariffs and sanctions on Russian oil due to the Ukraine war, oil prices spiked to over $120 per barrel. Energy stocks boomed, while airlines and transport companies plummeted. These real examples prove one thing: tariffs aren't just political statements. They're market-moving forces that can destroy or create millions in investor value in minutes. Part 5. Sectors most affected. Not all industries react the same way to tariffs. Some sectors are more vulnerable. Technology companies suffer because they rely on global supply chains. If semiconductors from Taiwan face tariffs, U.S. tech firms feel the heat. Automotive industries are hit hard because one vehicle may have parts from 20 different countries. Agriculture is another major loser. When tariffs hit U.S. soybeans, corn, or dairy, farmers lose overseas markets. On the flip side, domestic producers with little reliance on foreign inputs might benefit, at least temporarily, as foreign competition becomes more expensive. Gold, treasury bonds, and even certain ETFs tend to rise in volatile, tariff-heavy environments. Understanding sector-specific impact is key for portfolio strategy. Smart investors rotate their holdings, exit fragile industries, and move capital into more resilient sectors when the tariff threat looms. Markets will always rise and fall, but smart investors stay prepared. If you found value in this video, give it a like, share it with a friend, and don't forget to subscribe for more insights on investing, market trends, and financial strategies. Thanks for watching. See you in the next one.